McLaren as well as Genesis, which is essentially the yes the premium Hyundai models. Um, Revenue was down about 20% or 18 to 20% year on year. Essentially, TCA kind of gives us a proxy to the overall uh, vehicle market in China, which is quite interesting. So revenues were down because uh, the overall industry remained fairly weak. A lot of consumers are still remaining very cautious on purchasing big ticket items like cars. Um, so they did mention that a lot of their showroom volume was down quite significantly, but their conversion ratio, which is essentially how well they convert uh, showroom visits into sales, remained fairly healthy, about 20%. The name of the game is just less people coming to view and coming to buy cars in China. In terms of their uh, gross profit margins, gross profit was down about 55%. But if you take a look at the auto gross profit, it was down about 161%. So they're actually losing money on every car they sell on average. A big reason for this is because they're shifting towards selling more EVs compared to ICE vehicles, which have lower margins. They have lower margins because, first of all, uh, the EV competition in China is very strong. Secondly, TCA focuses mainly on BMW EVs, which are your more premium EVs, so they're priced a little bit higher compared to, I guess, your average EV, which is in the 150 to 200,000 RMB range. And so what the companies had to do is that they've actually had to issue more dealer discounts to actually try and compete and to move their vehicles. And this is a strategy that I guess they're fully invested in the short term because they're trying to get as much market share in the EV space in China as they can. The other business, which is essentially their after sales service, revenue was flat. This is where the company makes most of its margins from. So you can see gross margins for after sales servicing is like 35 to 40%. But there was, a little bit of a drop in gross margins, mainly because there was less car usage in China and also less accident repairs. So overall, for this company, it down 20% in terms of sales, but the base that they're actually coming off of in the first half of 2022 was very weak because I guess half of that the second quarter of last year was still most of China was still under lockdown, and so it's kind of showing that like how weak the Chinese economy actually is right now, um, at least with respect to auto vehicles in China. In terms of the outlook, uh, the company did mention that they are seeing a continued drastic transition to EVs in China, and they expect that to continue in the long term. And so, because of this, in the near term, there should be headwinds on margins, mainly because if they're selling more EVs, which are lower margin, it's just going to drive down overall margins. At the same time, they are a little bit more optimistic on 2025 because they mentioned that BMW is going to be launching a very huge lineup for its EV range, much wider than what they've had so far. And so that should at least boost, a lot of EV sales for the company. The auto industry outlook remains relatively soft in the near term, which I think is quite well known if you're following Chinese economy. So that's all for my counters. I'll hand it over to Glenn for SGX. Thank you.
Hey, thanks, John. Yep. So I think I saw we have a question regarding that the live whether there's live TA. Just to as a reminder, Zane is not around, not here today, so there'll be no TA for this session. Yeah. For today, I mean. Yeah. Thanks. Okay, so I'll continue on with the SGX results. They released their second half and full year FY23 results. So their revenue of 1,194 million met our estimates at 101%, while the adjusted PATMI of 503 million were above our estimates at 105%. And this variance came from higher than expected treasury income, offset by lower listing revenue. So for their dividends, their FY23 DPS increased to 32.5 cents from 32 cents the previous year. So I'll jump straight to the positives. First positive, and I think the biggest positive, would be that their treasury income has surged to a record high. So for they don't give so they give a breakdown of treasury and other income. It surged by 141% in the second half, and mainly due to the higher interest earned from their customer collateral balances. So if you drill down further to just treasury income, the second half treasury income on their collateral balances was reported at 90 million, and this is a 221% increase year on year from the previous second half's treasury income of only 28 million. So notably, their full year treasury income of 137 million, it contributed to 20% of their profit before tax. And this is a record high, surpassing their previous highs FY20's treasury income of 135 million. So jumping to the next positive, the second positive is that they had higher fees from their FTSE China A50 as well as the Nifty 50 contracts. So this managed to sort of pull up their equity derivatives trading and clearing revenue. So it fell by 10%, but their equity derivatives volumes actually fell 17% in the second half. So this was offset by the higher average fees from their SGX Nifty 50 index futures as well as the FTSE China A50 index future contracts. So for the average fee per contract for their equity, currency, and the commodity derivatives, it was higher at $1.61 in FY23 compared to $1.51 the previous year. This mainly came, as I mentioned earlier, from the increase in higher fee-paying customers for the China A50 as well as the Nifty 50, and together with the strong volume growth in iron ore. The third positive is that their FICC, currency and commodities, continues to grow, and it grew by 19% year on year in the second half as the volumes increased in their commodity and currency derivatives, primarily from iron ore futures, which were up 37% year on year in the second half, as well as their USD CNH FX futures and higher contribution from their OTC FX. So for a bit about their OTC FX, some updates. The average daily volume grew 7.3% year on year and to 75.8 billion, and they have maintained their target of 100 billion USD by FY25. And they said that they are on track to meeting these targets as the clients start to settle into the new platform. For the negative, the first negative is that their listing revenue continues to drop, and this pulled down their FICC fixed income revenue. It fell by 28% year on year. So there were only 469 bond listings, which raised 139 billion in the second half, compared to 687 bond listings raising 220 billion in the previous year. And on the cash equities, the revenue also was lower by 12%, mainly due to the listing revenue again declining 9%, as well as their trading and clearing revenue falling 21%, mainly due to the daily average trader volume, total traded value, as well as overall average clearing revenues falling. But nonetheless, their equities revenue was actually flat year on year, as the growth in their equities derivatives revenue put up the decline in the equities cash business. The second negative would be that their DCI, or data connectivity and indices business, the growth was quite flat this second half, and it still accounted for 12% of total revenue, but the growth was flat at 75 million. So for the market, this was mainly due to the dip in the market data and indices revenue, but it was pulled up by the increase in their connectivity revenue. So for the outlook remains relatively similar to the previous half. They are continuing to develop their multi-assets to anchor the long-term growth, and they are also investing for the medium term, guided for FY24 expenses growth of mid-single digit from FY23, as they do expect the FY24 expenses growth will be slower compared to FY22 and FY23, with bulk of the higher expenses mainly to continually build out their OTC FX business, as well as higher staff costs from salary increments. And they expect their medium-term expense guidance to remain at mid-single digit growth. But one more thing about their CAPEX, they do say that it will be higher in FY24, as there was a deferment of 8 million CAPEX planned in FY23, which will be deferred to FY24. And this CAPEX again is to support the growth of their OTC FX business, enhance their system architecture, as well as to consolidate office spaces. So for the rising rates, I'll touch upon that later. I have another chart just for the rising rates. and how it will affect their treasury income. But we do maintain a buy with an unchanged target price of $11.71. And the catalysts include continued growth from derivatives volumes and fees, as well as higher treasury income. So I'll move on to my next slide. Yep. So I have a slide on the treasury income growth potential. So if you look at this slide here, just a few descriptors on what the bars and the lines mean. The bar, the columns are the treasury income yield. So how do we get this number? So it's a basis points. We took treasury income, if you see the figures there, over their collateral balances, and you get a sort of how much do they earn in basis points terms. So at the peak, it was 110 or just below 110 or 109, and this was in FY 19 and FY 20. So currently, what they are getting is around 109 basis points. Yeah, and okay, so the red line would be the Fed funds rates. Yeah, so we're just trying to say that if you look at the previous high, which was in 2019 and 2020, the Fed funds rate was peaked at around 2.5%. And and currently it's at 5%, but the basis points, the treasury income yield, the basis points is quite similar. So we do feel that with the Fed funds rate more than doubled, there is definitely an opportunity and a chance for this yield and as well as the treasury income to further increase going into the FY 24. Yep, so that's all I have for SGX. I'll now hand it over to Mel. Thank you.
Thank you, Gun. Moving on to LendList. LendList releases FY23 results. Revenue and NPI doubled and were below our expectation at 94% and 91% respectively. FY23 DPU was at 101.5% of our expectation. DPU decreased to 4.7 cents, which is a 3.2% year-on-year decrease due to rising interest cost. We identify a few positives. Firstly, we expect a strong rental reversion to continue in FY24, with our rate achieving overall retail rental reversion of 4.8%, driven by GEM's improved performance. Sky Complex Milan experienced a 5.9% rental escalation. Tenant sales at portfolio level increased 2.5 times, surpassing pre-COVID level by over 16% in June 23. Will footfall have normalized to 100%. We expect the rental trend of GEM to stabilize in second half 23, while Somerset's rental is projected to gradually increase as international visitors return. Secondly, portfolio occupancy stays at 99.9% as of June 23, and tenants retention at 82.4%. Portfolio valuation experienced a 1.4% uplift, driven by GEM and Syrian at Somerset. Sky Complex Milan was the main setback, decreased by 9.2% year-on-year. As for negatives, gearing increased up to 40.6% upon completion of Parkway Parade acquisition. Rising borrowing costs are expected to continue in FY24 to around 3.5%. In terms of outlook, L-Rate has recently concluded the acquisition of Parkway Parade, securing 10% of the sponsor's stake, total 7.7% of the total value. The NPI yield is expected to rise to 5.6%, and we believe L-Rate will continue to increase its stake, and Singapore will remain its acquisition focus. As such, we reiterate our buy recommendation with a decrease in FY24 to 25 DPU forecast to 4.38 to 4.63 cents on the back of rising interest rate. Our DDM TP adjusts down to $0.86. We expect FY24 earnings will be supported by stronger rental reversion and potential inorganic growth. And move on to Cesar. Next slide, please. Yeah, next slide, please. First half 23 is rental income in SGD terms was within our expectation at 47.7% of our estimates, representing a 0.9 million year-on-year decrease due to weakening RMB against Singapore dollar. First half 23 DPU was within our expectation at 50.6%. For positives, all the sales up 20.5% and reached all-time high since listing. Hefei Outlet saw 50.2% surge in sales, and Chongqing Liangjiang increased by 20.3% year-on-year. The trend is expected to continue and deliver even stronger second half performance since mega anniversary sales is in third quarter and there's festival sales in fourth quarter. And portfolio occupancy achieved a record high of 97.2%. Chongqing Liangjiang reached 100% occupancy rate, while other three outlets remain stable at 95%. As for the negatives, depreciation of RMB and rising offshore interest rate were the main headwinds. RMB weakened by 8.7% year-on-year against Singapore dollar, and higher financing costs, which increased by 0.9% year-on-year, due to higher interest rate of the offshore loan. Moving on to outlooks, we expect second half 2023 to deliver a stronger performance, leveraging on the various sales events. And SASA has already hedged its revenue, so depreciation of RMB will place less pressure on DPU in second half. As such, we reiterate our buy recommendation with an unchanged target price of $0.9. FY23 to FY24 DPU forecast has been lowered by 1.5 to 1% after factoring a stronger than expected depreciation of RMB against Singapore dollar. Yeah, that's all for me. Now I'll hand over to Darren for CDL and CL. Thank you.
Yeah, thanks, Mel. Yeah, so for CDL, yeah, the results were the revenue was in line, but the PATMI was below estimates because of higher financing costs and some fair value losses. Yeah, so for the residential side, it looks like the revenue jumped a lot, but that's because they recognize the Piedmont Grand's EC full revenue and profit in its entirety upon its TOP. So excuse me. Yeah, so for the positives, yeah, the Singapore residential market remains resilient despite the cooling measures that was announced in April. So they have 508 units, while in first half 22 was 712 units sold. Yeah, but the one thing to note is that the sales, it did pick up in the second quarter with the launch of Tembusu Grand, which is currently at 58% sold year to date. The hospitality segment, it remains robust for CDL, excluding divestment gains, because last year they had a very exceptional good divestment gain for the Hilton's the Seoul divestment. And if you exclude that, the EBITDA grew 69%, and the RevPAR is 42% up year on year. But on the PATMI side, they are still making losses for this. As you can see on the left side, the hotel ops is making losses because of this divestment and as well as some one-offs and higher finance costs. Yes, so for the negatives, their borrowing costs, it rose sharply. It almost doubled from 2.4% to 4.1%, and it rose 3.8 times. So excuse me. Yeah, it rose 3.8 times year on year. Yeah, that's because the Fed started raising rates only last year, in March 22. So yeah, they kind of have almost a full year impact of the rising rates already. Yeah, that's why it rose so much as well. And another negative is that they have a sizable impairment and FV losses on their investment properties in the 34 million was from impairment losses in the UK because of cap rate expansion, and 20 million fair value loss on the property linked notes. Yeah, so for the outlook, they are looking to replenish their land bank in China tier 1 cities because they think that there's some pocket of opportunities there, but they are only looking at tier 1 cities and maybe the new tier 1 cities like Suzhou, so the classic tier 1 like Shanghai. Yeah, and for their property, their residential market side, they're going to be launching a 512 unit EC at Bukit Batok West. And we think that this probably would be a good project as we expect strong demand from it because it's near 3 MRT stations and it's near the new school, Anglo-Chinese school, which will relocate there to Tengah at 2030. Yeah, so with that, we upgrade our recommendation to a buy, but then because of the share price movement, the target price is actually lowered to 822 from 833. Yeah, so moving on to CLI. So for CLI, the lodging business was a star performer. but the first half earnings were below estimates due to lower portfolio gains, lower event-driven fees as well, and weaker performance in China. So as you can see in the results in the table there, the lodging business was a star performer. Under the fee income here, it grew 34% year-on-year due to the improvement in RevPAR by 32% year-on-year and more operational lodging units. And another good thing about the results was that their recurring fund management fees, it grew 10% year-on-year. So this is to offset the weaker event-driven fees, like in the market where deal making is more challenging. And they also managed to raise funds in a market that is battered by high interest rates. So they managed to raise 3.2 B. The whole of last year, they only raised 2.5. Yeah, so on the capital raising fund, they're doing quite good as well. But for the negatives, the REIB, which is the real estate investment business, it declined 3.6%. So this is because of the lower contributions from the properties in China, as well as some the loss of contribution from the divested properties in Singapore and Korea in 2022. They have a divestment target of 3 billion this year, but we think it's unlikely that they will hit it because right now they only have year to date they have 839 million only that they have divested, and the market is not really conducive for divestments and asset recycling in the current market. So for the outlook, we think lodging management will remain strong because of the travel demand as well as the high RevPAR. And we think that the event-driven fees will pick up in the second half. Like this year, it was down by 65% year-on-year for the event-driven fees because there was a lull in transactions. And we also think that if there's a stronger recovery in China or any big stimulus in China, that could be immediate catalyst for CLI. Yeah, so with that, we upgrade our call for CLI to a buy. Same thing as CDL because of the share price movement. We upgraded our call from accumulate to buy, but it's a lower target price of 3.68. And this is some of the parts calculation. Yeah, so this is just a quick overview of some of the REITs performance for the first half 23. As we mentioned before, the REITs, if they perform very well operationally, like their MPI has to increase by a lot because of the higher finance cost. So the MPI has to increase by a lot, and then finance costs increase, and then as a result, their DPU will remain kind of flat or negative. So an example is like here, CapitaLand Escort Trust. The MPI increased by 31%, finance costs increased by 33%, and the DPU increased by 19%. But if you can see across the board, only the hospitality sector, because of the growth in RevPAR and higher top line, then they managed to kind of pay out more DPU. But the other REITs in the other sectors, it's hard for them to match this kind of DPU growth. So you can see CICT is up 1.5%, and towards the right side is the negative DPU, where, like for example, Prime, they are operationally, we know the US is quite challenging for the commercial space. So the MPI, because of lower occupancy, it kind of decreased a bit. And as a result of the higher financing costs, their DPU was hit even more. So it was down 30.1%. But one thing you know is that Prime also, they paid their management fees fully in cash, which is why it's down 30%. Not, it would have been down 24%. Yeah, and for Keppel REIT as well, the MPI is flat, but their finance costs it shot up so much. But you see the DPU impact is only so little, but actually it's slightly more because they paid out a capital distribution from their anniversary payment of 10 million, yeah, to kind of boost up the DPU. Yeah, so this is just the performance for the REITs. Yeah, so that's all for me. I'll hand over time to Peggy now to talk on SATS.
Thank you, Darren.
Thanks.
Good morning, everyone. SATS had the results first quarter 24 business update last week. Basically, the numbers were in line. This quarter, they included the consolidation WFS, which was consolidated from April this year. So there's a full quarter of WFS. The column, there are two first Q24 columns there. The one without anything is the SATS only results. That means excluding the consolidation of WFS. As you can tell, the SATS only operations has improved. It's a higher net profit. even in spite of the absence of government relief, they had 70.8 million of government relief in the fourth quarter. Now no more from this year onwards. But overall the results were impacted by acquisition related cost of 29.7 million and higher interest expense. The acquisition costs, unfortunately, not everything is one-off, so some of that might recur again in future quarters. In fact, for the amount of intangible assets that they had to account for from the acquisition of WFS, they paid 3.5 million for it, a billion for it. The amount of how much of this 3.5 billion is intangible has not been decided yet. So the intangibles have to be amortized over the period. So therefore, there could be more acquisition related costs going forward, which we are not sure how much that be. The net debt has expanded to 2.2 billion. That's also in line with expectations, and that's the reason why interest expense has gone up. We think the interest expense is about 20 million this quarter. That has cancelled all the operating gains from WFS, and resulting in the 0.2 million net loss if we ignore acquisition costs. WFS is a cargo player. They are strong in US and Europe. SATS told us that WFS cargo volume has declined, but they didn't want to disclose the quantum. But if it is in line with the global weakness, there's about a 9 to 10% decline year to date from January to July. Okay, the SATS only operations was profitable. Besides the recovery in the travel volume, there's also other improvements, like the airlines are beginning to put in more food into your food tray. You notice your bread loaf has come back, and then hopefully they are probably going to have ice cream as well. This is due to increased competition, and also SATS is hopeful that the double catering would be reduced. They face quite a bit of competition from Dubai, and the Middle Eastern airlines have been doing very well in terms of adding back the routes, and most of them take their food from the Dubai airport, so that takes the business away from SATS. The cargo continue to remain weak, we believe, for the second half of this year, going by the manufacturing output numbers, and the higher interest expense will continue to be a drag on earnings. So we maintain a target price of $2.51. That's based on discounted cash flow, because all these one-off items are non-cash, so they don't feature in our computation of a target price. Thank you. That's all for SATS. I move on to Feet on the Ground. Thanks, Darren. Okay, this is CSE Global. We met with them after their first half results. A very strong set of results, mainly due to acquisitions they made in second half last year and first half of this year. You recall they had the rights issue, and with the money they went on to buy some companies. Okay, you can think of CSE as a system integrator. It's like a mini ST Engineering. In fact, the team was from ST Engineering previously. It's also a global it's an indicator. What they do is an indicator of the global macro trends. The key service that they provide is in process control, electrification, and communications. So the three sectors are energy, infrastructure, and mining. The key to the earnings growth is really based on order wins. So the order wins give us a early indication of where how well they will do going forward. Okay, the key cut the story short. They benefited from a few trends in the market right now. Like for instance, the infrastructure where they do a lot of data centers and EV charging stations and powering up the homes. That's really driven by thanks to Donald Trump, the low tax rate in Texas. So there's a lot of migration coming from the high tax states like California to Texas and Florida. So the migration, it means new homes are being constructed and built. So there's some electrical wiring and fixing of the solar panels, the EV stations, also because of the increase in the usage of electric vehicles and so on, and data centers. Okay. Then the other trend is that of the higher oil price that sends up that makes it more attractive now for the shale gas and shale oil players in the Permian Basin to bring back their production. Therefore, they also see higher volume from those operators in this the onshore energy production business. But for the offshore, the energy is fairly weak. Offshore mainly for them is the Gulf of Mexico, and clearly the offshore, because it's more expensive to drill, the demand is not as robust as the onshore thing. And yeah, that's basically the trend that they are riding on for CSE engineering. And for minerals and mining, the key markets is in Australia, and that is really follow the trend of the demand for fossil fuel, which we know is down because the banks are not financing these such projects, and also the commodity prices are not helping. Okay, so for these companies, the outlook is really dependent. A positive catalyst are the sustained oil prices, the higher EV penetration, a demand for data and connectivity, therefore driving the demand for data centers. But the negative is that the fossil fuels are not in favor, are not in getting a lot of support, and the commodity prices are weakening. So this all we gather from CSE Global. The one thing I would like to point out is that even though the top line has grown, the margins is very weak. Net margin is 2 to 3%. They're buying revenue, but the margin has to improve for them to hit the traditionally they get about 35 to 38 million net profit a year. So they are still a long way from there. Yeah. Thank you. I'll move on to the next one. Asia Pay TV. They had the second quarter results announced. The revenue, this is a cable TV operator in Taiwan, and they offers pay TV and broadband services. They had a lower revenue in second quarter, mainly due to a strong NT dollar. The revenue in NT dollar was actually up 1.9%. They have a net add in subscribers of about 10,000. That is about 0.8% Q and Q. And most of these net add premium and broadband subscribers, so they are higher paying, and that offset the churn in the basic cable TV. The EBITDA, however, fell because they paid higher broadcast and production costs as they negotiated new contract with content providers. But this higher cost also allows them to charge higher advertising revenue, which goes into the top line. So net there's probably marginal impact. The impact is not as big. Okay. The interest expense has actually fallen even despite the higher interest rate of 3.3%. That's due to because they have been conscientiously focus on loan reduction, especially on the offshore loan where they pay relatively much higher interest rate compared to onshore, which is pegged to TIBOR. Okay. About 85% of the loans are on fixed rates, and this fixed rate is the TIBOR fixed rate, so it's also very, very low. Okay. Another positive for them is that they still continue to generate positive cash flow, not for this quarter, but over the full year, we see that it will be a positive cash flow. In the past, they had 100 million operating cash flow a year, and capex for this year is projected to be about 30 million. So there's the extra excess cash will go to pay the distribution and also for powering down the debt. So the positive for this company and or the sector is that there's a growing demand for data, and the Taiwan internet penetration is still below Singapore and Hong Kong. The negative is, of course, like the same for the other REITs, the higher interest rates that might push up interest costs, and also higher interest rates will result in a lower asset value that will add pressure to the gearing. Gearing, the total debt over total assets is already 48.1%. That's all for me. I moved on to Paul for the comfort. Thank you.
Thanks, Peggy. I'll move on to Comfort Delgo's results. So for us, the outlook for second half will be all about repricing, building momentum from repricing. Next slide. So the results was within expectations. Finally, after a few quarters of disappointment. So in terms of the positives, if you look at the table on the left, you can see that taxi and private hire, the earnings doubled. So the reason for the earnings doubling is, of course, lower taxi rebates. So they were giving rebates or discounts to Singapore taxi drivers for 15%. This dropped to 10%. The fleet is, of course, much more stable. I think it's starting to grow very incrementally, but I think the last few quarters were down year on year. And also higher commission charge compared to the prior year. I think they raised it to almost 8% from 1 or 2 percentage points higher. And of course, there's also lower rebates or discounts given to the taxis in China. The second positive is the cash is still piling up. It's about 500 million net cash, and they are returning it to shareholders. So they actually raised their dividend payout ratio from minimum 70% to minimum 80%. You can look at the bottom on the left. Although dividend per share is only up 2%. The negative is the lethargic margins for public transport. So public transport is referring to buses. So they run bus in almost every country to operate. They run bus operations in the UK, in Australia, and in Singapore. And this also includes the rail business in Singapore. The margins is, of course, weak because of foreign exchange. I think there were at least 4 or 5 percentage points cut impact from FX in the UK and Australia too. And of course, what happened, like we highlighted before, is that in the UK in December of last year, they had to raise all the bus driver pay. Because as you can see, every sector in the UK is also asking for higher pay. So they had to do that, but they cannot get compensated until a year later because there's an anniversary to the contracts. So these are all service contracts that they win contracts not just to drive the bus around. In Australia, they were also hit by bus shortages, and as a result of that, there was overtime pay they had to pay because not enough drivers, and they also had to pay a little bit of penalty because without enough drivers they couldn't hit the scheduled times. So these things were all unravel in the second half. I mean, unravel and turn better. So in terms of the outlook, no change to our forecast, but we raised our dividends slightly because of the increase in their payout ratio. So in terms of the second half outlook, I think the drivers for second half will be, of course, public transport. Like we mentioned, there'll be UK indexing, so they can reprice all their bus contracts higher. And also competition is a bit more rational. I mean, they did comment that I think in 2019, 2020, the competition was really irrational with really small margins. But now, because of the losses faced by everyone, so I think competition is also a bit more rational. Basically, they are bidding the prices higher than even the CPI. Of course, the bus shortage will also improve, and rail volumes in Singapore are still rising about 20%. These are not MRT rail volumes. In taxi, the driver for taxi will continue to be in China lower discounts. Then they introduce a ZIG platform fee, I think 1st July by 70 cents. So this will help grow revenue as more and more passengers use the platform. They also secured like 4,000 extra drivers, third-party drivers. That means these are not taxi drivers. And of course, the fleet is more stable. I think just to conclude, the difference now is that they have the Zeek app. And with this Zeek app, they can now compete better with all the ride-hailing apps like Gojek and Grab. And the other phenomena happening is, of course, the lack of drivers. As to why, in case anyone asks as to why Grab is looking to acquire Transcap, I don't think it's because of licensing. I think it's mainly because they are looking for drivers too. Everyone just scrambling for drivers because of the shortage. Next slide. So I'll just run through my weekly. So in terms of the weekly, most of the macro numbers from Singapore is generally positive, except for exports. So exports in Singapore continue to be weak. It's down 20%, June of 16, so it's getting worse. And also electronic exports is also down. I think that's sliding for almost 10 months. One positive is the property new launch, excluding EC. We exclude EC because EC is very volatile, can be quite lumpy. So excluding that, I think volumes are up almost 70%, the highest in 20 months. So the property sector, like we highlighted in PropNext, is that you don't expect weekend launches to be that strong as before, because last year there was 4,000 launches. This year is going to be 11,000 launches. So it's almost tripling of launches. But this could boost up volumes, but not the take-up rates. SIA continues to grow their passenger almost 32% year-on-year. We always look at, when we look at Taiwan exports that just released last week, that is also down about 10%. Similar to what's happening in Korean exports and Singapore exports. There was a slew of Chinese data coming up, but in general, the weakest part is fixed asset investments. Mainly dragged down by the private sector, down 7%, but the SOEs are the one popping up the fixed asset investments. Residential is still continues to be weak. Residential sales is down a huge 25%. I mean, worse than during the COVID times. It's a major 25% year-on-year. Retail sales is also slowing down, but the online sales surprisingly is what's doing well in China now. I think online goods is up 20%. Services is very strong in China. I think like up 32%. We sink down to US just very quickly. So what spooked the US markets? That the Fed could actually look to raise rates in September is also because the retail sales, excluding MV, excluding the volatile motor vehicles, actually up 2.2%. So although it's very small, 2.2, but it just it was above expectations. If you want to know what is the American consumer spending on now, is what's driving retail sales is still food and beverage, spending in restaurants and so forth. Online is actually doing very well. Health. The weak one is all those housing related items like furniture, building materials. Electronics is also still down. The last point to talk about on macro is the Fed minutes. So of course the Fed minutes, all of us, everybody will just read through and see if there's any hints of what is the next move, or at least their sentiments. It's a bit mixed. I think some of the Fed members said that I think the current interest rate level is enough, and it will surely will progressively hit their inflation target of 2%. Some still see upside risk, but I think in Jackson Hole, on Friday, that will be the one that's going to be where everyone's going to be watching for what the Jerome Powell will make a speech on Friday. Next slide. So next view, so in terms of tactical views, right? So we, despite all the negative news, I think we are still hopeful on China. We'll explain why. The keyword here is hopeful. We're not saying that we are ultra optimistic, but we think that the data is not as catastrophic as what is out there. Of course, it's definitely slowing down. There's no doubt about it. But what we think is happening when speaking to the property developers is that in China is that the private sector and consumer sentiment is very poor. So at least for property buyers, what they're doing is just waiting on the sidelines because they think there's going to be sentiment, and of course prices are coming down, so no rush for property buyers to go in. But we still see positive macro numbers, although not many will believe it, but actually steel production is actually up almost 11%. What is happening in China is that the steel exports is like almost 6 or 7 year highs because of the weak RMB. In China, they're exporting a lot of steel into Southeast Asia. electricity is also up. I mean, we measure electricity just to get a sense of the activity levels in China. So that's up about 6%. Then online is still very strong. So not not the whole of China is collapsing or catastrophic. There's still pockets is doing well. Another positive for China is that unlike other countries, China is easing monetary policy, whereas the rest is tightening. Of course, the thing is when to time this thing. The problem now is that it is still 20% above the lows. So the Chinese market or the Hang Seng China enterprise market, the index was actually still 20% above the lows in October. So I mean, if the negative sentiment continues and there's no stimulus, so I think we could actually trend towards that. So in a way, there's almost maybe 20% downside risk. I mean, we're not China experts, but just to look at the chart. So the key thing is the stimulus. I think we still think the stimulus is likely, mainly for two reasons. There's a delay. I think everybody wanted the stimulus like yesterday, but we think it's delayed because it's only in March of this year that China installed the new political lineup or the new team. I mean the new set of government authority or government officials like the premier and so forth. And we think that the China data really slipped only in May and June. So it's only quite recent that the data really slided quite sharply, because before that, from January to March to April, actually the Chinese data was really quite reasonably healthy. So we think the stimulus will happen. Just that for these reasons, I think the delay is quite understandable. So for the US, the US market has been was weak last week. Mainly because of the treasury yields, basically bond yields or bond interest rates in the US, the 10-year hit to 16-year high of 4.3. What spooked the market is, like we mentioned, retail sales was higher than expected. I'm not sure how much higher, just a little bit higher, but anyway, that shows how jittery the market is. And also, I think in end July, this is not new, but I think probably people reminded that the treasury is borrowing a lot. That means the US government is borrowing $1 trillion from July to September. I think it's higher than their estimate of 600 plus billion. And just to give you a flavor, this is like the prior quarter, they were borrowed about 600 billion. So 1 trillion is, I guess, going to be a huge amount for the market to absorb. And probably that is why technically that kind of caused the yield to jump up. And of course, there's also a worry that after Fitch downgraded the US government sovereign rating from AAA to AA, that Fitch could also be downgrading the US banks, because you can't have banks having such a rating even higher or equivalent to, I guess, the government itself. So we move on to some of the events coming up for next week. It will be NVIDIA, the big one, and of course on Friday, Jerome Powell will have a speech, and so that's also the kick. Later today at 3 p.m. we have a Singtel briefing, Singtel webinar. So do sign up if you have the time later at 3 p.m. Next slide. So I'll just conclude with some illustrations of the slides. Okay, nothing but pessimism here, but I think exports are continue to slide down. But you can see that it's starting to bottom up a little bit. So maybe fourth quarter you could see some mild improvement in terms of exports. So it seems to be, because year on year things will look better because of the base effect too. So this should actually recover later on in the fourth quarter. But Korean exports, Taiwan, Singapore exports are all sliding down, as the chart suggests. Next slide. Then the next two slides will be just on Chinese data. So you can see that fixed asset investments is sliding down. The best years, if you look at when China was a very popular market or hot market, you can see that investments in China was as much as 20-30%. Now it's only 2-3%. It's mainly the private enterprise, the beige color that's coming down. The SOE is still holding up, but I guess the confidence by the private sector has clearly illustrated here. They're not investing in anything. It's actually investments are down. Property sector continued to slide very sharply, even when we're comparing with the pandemic. So actually, the irony is that when the reopening, it just slid even more. The last 2 years. Next slide. Just one last slide. Sorry, no more China slides. Oh, yeah, I think I omitted one. But anyway, just one last slide on Singapore. It's just that because of the New Year rally speech, just a reminder that the aging is quite steep. So this blue line is basically the Singapore population, those aged 60 to 84. You can see it's sharply rising to almost, I don't know, 1 point something million. The red bar is basically the incremental change, and the numbers that we put here is that the increase in the number of people 60 to 84 over the past 10 years to 2002 is 130,000. Then this doubled to 200, or almost tripled, I guess, or doubled to 290, and then doubled again to 600. So the last 10 years up to last year, almost 600,000 people is in this 60 to 84. And then this will again increase. So what it basically means is that it's going to be a huge drain in Singapore's healthcare resources. So I think that's why the government is announcing all these things like Healthier SG and more more resources going to be spent for the aging population. I mean, this is just for reference, but I guess the key takeaway is that healthcare will be the main growth driver, main area of spending, I guess, because of the aging population. Okay, I think with that we can go straight to Q&A.
Let me take some of the Q&A first. I think got a few on SGX as well as the banks one. Okay, when the first one. Okay. Why is the treasury revenue from float not reflected? Actually, it was reflected. It was in the second chart with the just purely on the treasury income where I put the last 4 years. So anyway, just to reiterate, the treasury income for FY23 is at 137 million. Yep. So this is higher than the FY20's one of 135. Okay, one more question. Can you elaborate on treasury income for SGX on customers' collateral? What is an example of such collateral? And shouldn't the interest earned belong to the customers? Yeah, so very good question. Yeah, so the treasury income, the collateral balances, one of the good examples would be the margin deposits. I think that goes into the second question, which you also asked. Where can we find the information on collateral balances in the balance sheet? So this can be found, so they don't name it as collateral balances, they name it as margin deposits. So if you look at the part 42 or B1, sorry, 42B1, which is page 94 of their balance of their audited financial statements. They don't give it half yearly, they only give it on their full year. So you can see there they put margin deposits cash, it's at 11 billion, 11.244 billion. And I think your second part of the question I'll try to answer now. Shouldn't interest earned belong to customers? Yes. So they work in a way similar to a bank, where you put money with them, where they can earn they will earn a spread basically. So they will put it into higher interest earning sort of like fixed deposits, for example, 6 months, maybe 3-6 months, where they will earn a higher interest, and then they will pay the customers probably like an overnight rate where it's lower. That's where they earn the spread. Okay, next question. Sorry, let me scroll down and find it. Oh, yeah, so it's back to the banks now. Hi Glenn, with the property debt defaults and shadow banking in China, which local Singapore bank will be the most and least affected by these negative sentiments? I would say I think the banks are all pretty similar. If if you look at how would they be affected, it would be the sort of the amount, or the proportion of their loans to mainland China, which we will try to base the whether you'll be most or least affected. And all the banks, is very similar, as maybe 1 to 2% of their total loans. And for the property sector in China, so I would say there's no most and least, but maybe if you want to look at the most side, would be possibly OCBC, because they are trying to grow their Greater China sort of revenue, and they have mentioned it in their they have mentioned it in one of the don't know what you call it, their presentations before their their second quarter 23 results, where they said that they want to have this incremental 3 billion of revenue. But I think it's mainly coming from their wealth management side. So I don't think that, they're all the Singapore banks are quite cautious on approaching the property sector in China. So they are keeping a very prudent stance. So they will probably be OCBC at least will be going towards trying to work and improve on grow their wealth management in China. Okay, I think I got one more. Oh, wait, so there's two more. Let me take the SGX one first. SGX treasury income potential. Will this be affected? Will this also be affected by lowering SG interest rates trend, even Fed rates remain high? Yes. So yeah, the Fed rates remain high. I mean, our Singapore interest rates are quite closely packed, or tagged to the Fed rate. So if the Fed rate remains high, I think our interest rates will remain at elevated levels, at least for the time being. And they're not very I'll say they don't really elaborate much on how they make their treasury income. So our best guess is that they might be putting it, this is just a sort of a guess, where they might be putting it in USD, where they earn USD, because most of their margin deposits might be in USD. So so even if the Fed in Singapore interest rates dip a little bit, if the Fed rate remains high, they will definitely still be earning that good spread. But then again, if the Feds lower the rates, they start to cut rates, then definitely they will be affected. So you can see in FY22, which was last year, where they only earn, I think, like 50 million of treasury income. So definitely they will be affected. But of course, now with the high interest rates, the treasury income is still going to grow, because there's sort of a bit of a lag where you look at how they earn their treasury income. Okay, last one for me. Oh, sorry, got two more. When Fed starts to pivot and loosen monetary policy, will the lower Fed fund rate affect Singapore's banks' net interest income and PATMI negatively, indirectly lowering DPS in the future? Yeah. So if you look at the way the banks earn money, it's very, it's really quite, at least for their net interest income and their NIMs, is very closely linked to how the interest rates are how the interest rates are. So higher interest rates, their NIMs are record high. If you can see now, high interest rate environment, their NIMs are very high. But if you compare during COVID, when interest rates were almost zero, they had very low net interest margin, and then resultantly net interest income. So yes, you are right, it will affect their net interest income, but PATMI wise, they might not see as high of a growth, if the rates start to decline again. But looking at this, the rates are expected to remain high, at least not going to increase. It might increase further, but not much. But the rate cuts might not be as soon as what may not be as fast, sorry, as how it went up. So will it indirectly lower the DPS in the future? Yeah, there's a possibility that it will lower the DPS, but I think the banks have also mentioned that they want to keep their DPS at the current levels. So when they raise they don't raise it very high as well. They raise it by maybe by a bit. So they are taking also quite a prudent stance. They're also looking at this, saying that the rates will not remain at these elevated levels forever, right? I mean, it's definitely not possible. So they are obviously taking it in a very safe way by increasing their DPS slowly. I think most of the banks are paying 50% of a 50% dividend payout. Sorry, 50%. Yeah. So they are keeping it quite safe currently, and they have also not. I mean, during the results briefing, a lot of analysts have been asking, like, so what is your outlook on your DPS? Is there room to grow? So most of them will just give a very sort of non-confirmational answer and say, yeah, there is definitely room to grow, but they do not want to put themselves in the spot and say, yes, we are going to increase our DPS, because they also are not very sure when once the Fed start to cut rates and interest rates start to lower, how much will it affect their net interest income and their interest margins and their PATMI. Hope that answers the question. Okay, I'll take the last one later. I'll hand it over to my colleagues first. Thanks.
Thanks, Glenn. Let me take one question here. There's a question here. Hi, John. Why is your N reducing the target price for C from 100 to 87? Is this because your N is following the recent drop in price, hence your reduction, or is there more qualitative issues? So we essentially reduced 2024 estimates by about 3%. At the same time, we also increase the share outstanding base by 8% because there was some sort of share dilution that we couldn't really figure out what it was. And so at first we thought it was a conversion of their convertible notes, but when you take a look at the balance sheet, they didn't really move. So we're not exactly 100% sure, but because the shares got diluted, we had to basically adjust our denominator, and then that's kind of how we arrived at the $87 tag price. Hope that answers your question. Thank you.
Hi, I will take the Lendlease and Suntec question. Why is Lendlease and Suntec retrading at a huge discount from book value, despite their properties are very good quality and high occupancy? It's more of the market sentiment due to the interest rate hike and the weaker macroeconomic outlook, which could potentially result in lower office and retail demands. Suntec has only hedged 58% of their interest rate. So DPO in first half 2023 was like hit badly by the rising interest rate. And we also expect the borrowing cost to peak in FY24 to 4.8% after they refinance the 900 million loan. And Suntec will also be one of the first rate to recover once Fed start to cut their interest rate and also cost their hedging ratio is very low. And for Lendlease is the revenue and NPI doubled in FY23, but DPO was down for around 3% due to the rising borrowing cost. Since they have already refinanced the 300 million euro loan, which is 1/3 of their total borrowing, we don't expect a huge increase in borrowing costs to rise again. And they also will be finished constructing the Live Nation in FY24, and that could potentially attract more traffic to 3 as Somerset. Yeah, so mainly it's because of the market sentiment of the interest rate hike and weaker macroeconomic outlook. Yeah. And there's also a question for Cesar. Are there a knock-on effect from China's economic condition? Well, I'll say like the knock-on effect from China's macroeconomic condition is marginal. Cesar has a track record of beating the average Chinese retail sales. Yeah, so in a way it's a bit isolated from the general economic condition. Like in first half 2023, China's retail sales increased by 8.2% year-on-year. But for Cesar, it's like 24.5% increase year-on-year of their outlet sales. That is because their target customer is mainly the middle-income families in China, and the numbers are constantly growing. They also have a very clear value proposition, which is the bargaining products. So it's low cost but have value. So it's very highly differentiated from other general retails. So under this kind of macroeconomic condition, it's even more favored by the middle-income families, because like once they don't have enough budget for the luxury brands, they'll choose the outlet products instead. And moving on, there's a question for Cesar and Lendlease, the dividend yield. For Lendlease, FY24 to FY25 dividend yield is 6.53% to 6.91%. And for Cesar, FY23 and FY24 dividend yield is 9.35% and 9.58%. I don't see any question for me. Yeah, I hope it answers your question. I'll hand over to the rest of my colleagues. Thank you.
Yeah, thanks. Maybe I'll also answer some questions. Yeah. Hi there. Do you think it's worth to buy Manulife US REIT now, considering there's so much below its NAV? Yeah. So Manulife US REIT now, its NAV is about 40 cents, and the last trade price I saw was about 8 cents. So that's trade about 0.2 times. Yeah, but personally, if you ask me, I think there's just too many uncertainties regarding that, because right now the issue with them is that their loans, right, because they are seeking the waiver from the banks, so their their loans are now all current liabilities. So if they were required to pay out these loans, then they will have a bit of some issue there. They need to pay off all their current liabilities immediately. Yeah, so to follow up, there's another question. In the event that they decide to liquidate and sell away all these properties, unit holders should be entitled to receive the book share, right? Yeah, so let's say if they sell away all their properties and they liquidate, yes, technically, yes, they would, after paying off all the creditors and such, right? They will, yes, they will be able to get the book value per share after that. But then the issue is, right, is whether they will be able to sell. Because right now, the US, there are not many transactions. And then assuming if you can liquidate at all. So the NAV of 40 cents is assuming they can liquidate at the current valuations. But if they do a forced sell, it's very unlikely that they will get that amount. So likely they will sell at a discount and a big discount at that because nobody wants to buy. The bid spread for property transactions are very huge. So if you get hit by that, and then the value you sell is much lower. So yeah, it probably will you will highly likely won't get 40 cents or so. So it'll be under. Yeah, so I think personally, yeah, I would stay away because that is just too many uncertainties for now for Manulife.
So let
Yeah.
me just so let me just add just for everyone's benefit, like what is the events to watch for. So for Manulife, the first thing that needs to happen is that they need to negotiate with the banks because there is a breach. They breached the 60%, correct me if I'm wrong, right?
Yeah,
Zidane?
60%.
Yeah. So they breached that covenant. So because they breached, they have to negotiate with the banks to say that this is not a breach, then this will allow them to pay dividends. I'm not sure what's the amount, but depending on the negotiation, then once that is resolved, then the next part will be if they sell one of the properties of PIPS to the sponsor. Then if that is resolved, then they can do a equity fundraising. So there is a excluding the external environment, so there is a path to recovery for Manulife share price. I'm just talking in terms of the news. So if anyone buys now, you're just taking a bet. You're virtually taking a bet that Manulife doesn't go under, and you're only taking that bet because you think the sponsor will eventually, there's Manulife, will eventually come in to support this to support this REIT. And there is a high probability they will, because I don't think it is going to look good for Manulife as an insurance company when they see headlines all over that there is a Manulife US REIT goes into liquidation and so forth. So if you go in now, you're just making a bet that the sponsor will come in. But these are the three events that could help them recover. That means the bank, they conclude negotiation, the bank, they sell the PIPs, and then they will do an equity fundraising. This is one possibility. Just to add what Darren mentioned.
Yeah, so hope that clears the question. Yeah, so the follow-up is unit holders should be entitled to receive the book value right in case they liquidate. Yeah, so that is not quite as I explained because it's very unlikely that they can sell at the book value of 40 cents. So yeah, I'm not sure what they can sell at. So yeah, you will get much lower if in the event that they liquidate. Do you have any view on CapitaLand and Scott Trust in the 6 months to a year, and should we subscribe to the rights issue? Yeah, the rights issue is 29 for 1,000 shares. And the rights issue is priced at $1 and 1.025, so $1.02.5. Yeah. Versus the current share price, which I last checked was 1.01. Yeah. So I think they'll kill me if I say this, but I personally I don't think it's worth, because if you the current share price is really under the placement price. So I mean the preferential offering price at 110 at 101. So if you want to top up your position, I think you'll be better off if you just buy off the market at 1.01 versus the preferential offering at 1.025 cents. And on top of that, if you do subscribe to the preferential offering, you get this odd lots issue of 29 cents. And odd lots is quite when you want to sell odd lots, it's very troublesome. So yeah, that's just me. Yeah, I hope that answers that question. Yeah, next one is CDL Hospitality Trust keeps falling. Can you please explain the real fundamentals of this stock? Is it worth keeping? Yeah. So unfortunately, we do not cover CDL Hospitality Trust. Yeah, and then there's a follow-up question to that as well. So let's answer that together. Regarding CDL Hospitality Trust, although traveling is picking up, it seems the REIT has quite a fair bit of loans to be refinanced in the next 2 years. The higher financing costs may mean that the DPU may not increase even though traveling is recovering. Is my understanding correct? Yeah. So like I mentioned, the cost of the recovery in travel and the RevPAR is growing. So most of the hospitality REITs are CDL Hospitality Trust included. Their MPI is in fact growing. Their top line is growing, but they are still hit by higher interest rates. And when I took a quick look at their loans, the bulk of the loans that are expiring in 2024 are fixed rate actually. So this fixed rate, when they do refinance this fixed rate, it will be refinanced at a much higher rate at a floating rate. So they will be hit quite hard when they do this refinancing exercise. So it will definitely hit their DPU, but I'm not sure. I can't say for sure whether their MPI growth will be able to offset this increase in finance costs. Yeah, cost is yes, this forecast statement. Yeah, I'm not sure about the future. So yeah, they will be hit definitely by this higher financing costs in the next couple of years, 1 or 2 years, because their low fixed rate. And right now their fixed rate is at about 52% only. Yeah, so it's their 52% is kind of similar to the CapitaLand CLI and the CDL fixed proportion, which we saw in the first half they got hit quite hard by the interest rates. Most REITs are around 70 to 80% hedged. Yeah, there's one question. CDL, can you elaborate more about property link note? Is tenor, nature, underlying assets, and geography of the underlying assets? Yeah, so for this, in the results announcement, they didn't really mention a lot of details on this, but the only details that I know is that is for the property link note is for project in Australia. Yeah, so actually, if you like, I can help to I can find out more about this particular property link note and whether there's a potential of loss depending on certain events, etc. Because you asked question anonymously, I do not know your details at email. Yeah, so if you could drop me an email, I can figure out and I can reply you when I get the details. Yeah, so sorry about that. Yeah, I hope to get the email from you. Thanks. Yeah, can you share with us some key takeaways from the webinar with Prime US REIT CEO last week, particularly the outlook for the REIT? Yeah, so Hamid, which is the CEO, he mentioned that the leasing momentum is weak, and they do have some tenants like the second largest tenant or a third largest tenant is will vacate the space, but he does see some demand from a big leasing demand, but he also mentioned that there's a longer lead time, like it takes longer to get into discussions. So even though the leasing demand is for some of their assets, is kind of the recovery is kind of split. So some properties are doing good and some is still quite weak. So for them it's like a split. Yeah, so we do he also acknowledges that it's weak in the US, especially the transaction space. So acquisitions, divestments, very unlikely in the near term as well. But the thing to note is that they did not do a valuation in the first half, so they're not facing similar issues with Manulife for now. They do have a 15% valuation buffer from the 2022 year-end figures. Like if from 2022 year-end, the valuation declines by another 15%, then you'll hit the 50% gearing, MAS gearing limit for them. Yeah. So yeah, so I think that's all I have to say for that. Yeah, Manulife, I thought they have repaid some debt to bring down the covenant breach of 60% to 57%. Yeah, you're correct. So they call this like something like a goodwill payment, but the thing is once you cross the 60% mark, because they crossed it slightly, the unencumbered breach, right? Unencumbered loans to unencumbered assets, they crossed it to 60.2%. So once you cross it, right, even if you bring it down, it's still considered a breach, and doesn't mean that once you bring down to under 60% means you are no longer in a breach. Yeah, so they're still in a breach and they still need to seek the waivers from the lenders. And basically, they need to get certainty that they will be able to pay off all the outstanding debt before they'll be able to pay dividends, like Paul mentioned earlier. Yeah, so this bringing down of debt to 57%, this is just like a goodwill thing, but it doesn't really change the dynamics of the breach. Yeah. Yeah, I think there's one more question for me. Hi, Darren, what factors can cause CapitaLand and Scott Trust to ease further? Yeah, I'm not quite sure what this question means. Yeah, but they are hit quite hard by, yeah, as we know, the EFR, like those REITs that did EFR recently, they all fell quite a bit. So the market is generally not so open to EFRs from the way I look at it for now. So those who did an EFR, their share price kind of dropped quite a bit. Yeah, so
EFR is maybe
oh,
not
sorry.
explain possibly.
EFR is equity fundraising. Yeah, so sorry about that. Yeah, so basically they do a preferential offering or raise funds in the private market, like placements and such. So placements or equity fundraising, like the rights issue. Like so for CapitaLand and Scott Trust, there are these most recent, they tried to raise 300 million, or rather they will raise 300 million, 200 million in placements and 100 million in preferential offering rights issue. Yeah, if I remember correctly. Yeah, so placement is to private investors, and the rights issue is basically to those who own, like, let's say for this case is if you own 1,000 shares, you can subscribe to another 29. Yeah, so yeah, I'm not quite sure what you're trying to, what the question is asking here when you say class to ease further. Yeah. Yeah, so overall, our view on class CapitaLand and Scott Trust is still a buy. We have a buy recommendation of 120. And then there's a question, if the preferential offering price exceeds current market price, under what circumstances can class reduce the preferential price? Or yeah, they already issued. So yeah, I don't think they can. Okay, so this is more technical. I'm not sure whether Paul or Peggy knows about this, but from my point of view, I don't think it's possible that they can reduce the preferential offering price because it already was priced at 1.025. So yeah, I don't think they can move it down anymore. Yeah.
The issue is fully underwritten also. So
Oh yeah.
yeah. And there's a placement tranche. So if the discount is too big from the placement price, the placement has closed. So they have some explanation to do. So I think unlikely they can move the price. Anyway, the it's fully underwritten, so the banks have to take it.
Okay, yeah, thanks, Peggy. Yeah, so that's all from your hand over to rest of my colleagues. Thanks.
Maybe I take over from here. Just two questions for me here. Hi Peggy, can you name a direct competitor of CSE? Of course, the ST Engineering, the electronics division, that's almost some of the things that they do is quite similar to CSE, like the setting up the EV charging station, all that powering up or process controls on the data centers and so on. This part of the business, even Keppel has a little bit of involvement. But actually, some time ago, like maybe I think more than 20 years ago, we do have some listed companies in Singapore who are doing a lot of this system integration work. They were very well run, but they have been either privatized or taken over by the private equity fund. So in Singapore, probably ST Engineering is the closest. Yeah. The second question is also on CSE. Question is, you mentioned positivity from their business in mining, EV and data connectivity. What is the percentage of this business segment relatively reference to their overall business? The EV and data connectivity, they falls under infrastructure. So and it can be in Singapore or in the US. That's 47% of the revenue and 69% of EBIT. For mining, this is mostly in Australia. There's 9% of revenue and also 9% of EBIT. So I hope I answered that question. Pass on to the rest. Thank you.
Okay, sorry, let me take this last one for me on the SGX. How does SGX separate their regulatory and profit-making functions? Yeah, so I mean, there are definitely quite a few things that the SGX does to separate this. So firstly, there's a clear separation of departments. So, you know, they do have a separate department or separate arm for their regulatory function, and then profit-making, of course, is a separate one. So for their regulatory, they have an independent regulatory arm, which is known as the SGX Regulation Private Limited, or RegCo. So yeah, so this one is over. So the most important thing is that of course SGX is sort of subject to MAS oversight. You know, so that's the biggest one. So where, you know, they do have a lot of articles out there where they talk about how they are making sure that they're ensuring everything is in line, you know, and there's no you know, everything is transparent firstly, and then there is regular reporting, transparency, as well as a code of their conduct and ethical guidelines. Yeah. So if you want to search, I guess you can find a lot of these articles on how they do it. Yeah. I won't go into the nitty-gritty here. Okay, hope that answers the questions. Thanks. I'll hand it over to the rest of my colleagues. Thank you.
Oh, okay. Let me just try to answer. Then we can hopefully then maybe can wrap it up. So sorry. Let me go which other one. Following the Sunday's National Day rally speech, why did property counters decline sharply this morning? Are there new launches currently too high? I don't see any triggers for it. The only thing I can say is that I think the real estate agents were hoping, not real estate agents, but the industry was hoping there will be more incentives given, more grants given for HDB resale or resale buyers. I think there was some speculation there will be something like that, but I think that you saw for the national rally, maybe they made those HDB at the prime areas cheaper, but at the same time you have to, wherever profit you sell, I think you have to give back the grants. So I think it made it more even. So I think that could be the only thing. Apart from that, I don't see any particular news that was negative for property counters. It was more like neutral. But there was some speculation, maybe they thought there will be higher rebates, which also a bit unlikely since the property market is quite vibrant. Yeah, I'm not sure if the rest have anything to add, Darren or Peggy. Which sectors are likely to benefit from the feel-good effect of the first presidential effect? Example, telco. I don't know whether there's any feel-good effect of maybe the holiday. Of course, there's a holiday, so I definitely feel good because there's a holiday on that day. But I don't think there'll be any impact to the stock market, like telcos. Okay, I mean, if you want to push it, then maybe telcos benefit because everyone goes on holiday and there's more roaming revenue. But I mean, it's not going to be significant. Just one day. But I mean, if you want to kind of corner and have one particular feel good, it's probably the holiday effect. I mean, that's probably the only one. For ComfortDelGro, do they disclose how many percent of the revenue is from Singapore, UK, and Australia? So in general, you can just take it as 60, 20, 20. Singapore is 60, UK 20, and Australia 20. Roughly, it doesn't mean the rest don't have, but no, just rough. But most important is the profit. I think like 80, but in terms of profitability, 80 comes from Singapore, then UK was loss, and then Australia was profit. But that's why UK will turn around because it takes up so much of the revenue. Prospect of Samudra Shipping. So Samudra Shipping, for those don't know, is a container shipping company, but they are not those big containers like Maersk. They normally do the Asian route, intra-Asian route. So for us, we are container freight rates are down almost 80% or sometimes even 90%. We doubt there's any recovery because world trade is weak, and also there are so much new orders coming out. I think almost 30% of new vessels being ordered. You can just think of this as a sector that over-earn, something similar to what happened to the rubber gloves. I mean, when the pandemic happened, a lot of companies over-earn. That means they earn more than what they normally would have. I mean, so that's why we are a bit more. We don't think the recovery will be soon for them, because once you earn, these are still commodities industries, and then once they earn so much, they will order a lot of vessels. Then something similar to the rubber gloves. Once they earn so much profits, right, then they start to increase their capex and capacity. So now that the capacity has jumped out, they will take another few years to the demand supply to kind of even out again. Okay, this one I'll leave it for the rest for Miao. I think this Lendlease is here. Hi Paul, based on the latest financial results of Yang Zhejiang Financial, any change in the views? Previously you're quite neutral on this. Actually, I was quite negative, but for Yang Zhejiang Financial, those who don't know, they are part of the Yang Zhejiang group. They de-merged, I think last year, sorry, but not the exact date, but they de-merged, and they were mainly into lending, i.e. money lender in China. I mean, don't quote me, but basically they were lending corporates. They were lending money to corporates, and then when they are shifting most of this corporate lending business in China into private equity in Singapore. But you notice the recovery in earnings mainly came from mark-to-market gains. That means a revaluation of some of the assets. But as in any business, everyone looks at recurrent income. So one of these markups, maybe some of their private equity funds has an improvement in the valuations. I'm not sure which one, but so anyway, why we were negative on them is because if they were still lending money in China, I think that would be still be a very strong positive. But they're taking all this revenue, taking all these funds in China and bringing it down to Singapore to build a fund management franchise. So as you know, when you build fund management franchise, you can wait at least 2 to 3 years before something material happens. So that's why we think the operational earnings will come down. This first half, I think, is up because there's some mark-to-market fair value gains. And the second thing is, of course, everyone highlights that Yang Zhejiang Financial is trading at, I think, 30% or 40% price to book. But I think in China, the banks also trading at 30 to 40% price to book. So you want to buy a China state-owned bank or buy Yang Zhejiang Financial? So I'm not sure I think the conclusion is pretty clear. I think, and the Chinese banks, I think, paying 8 to 10% dividend yield, if I'm not mistaken. I mean, the last time I checked. So the question is, if you're going to buy Yang Zhejiang Financial, why not just buy a Chinese bank if you want to have exposure to this segment? That's my view. Or unless you think they're going to do extremely well running a PE fund here in Singapore. I mean, that's the other alternative view. Okay. But what's your take going forward for ComfortDelGro based on the latest outlook? So we think second half will be where finally, after a gazillion years, so finally we think the second half, the earnings will really grow. I think second quarter was more like flattish, slight improvement. But I think second half is where you'll see the big earnings jump. And I think that's why I think you can see them doing more marketing, more roadshows actually. They're also doing a presentation with us. Do sign up for that. I think it's 20th September. I think just go to the POEMS website and have a look. What's your view on Singtel's results, rating, and target price? So for I haven't run through the numbers. I mean, I did see, but we are neutral on Singtel. I think so mainly the big re-rating for Singtel, if it happens next year, would be these three things, or maybe two things. It will be basically the non-telco business that will get the re-rating. So number one, the main driver for Singtel will be there's this 6 billion of divestments they want to do. So it will be something almost similar to what Keppel Corp, sell things. So they might sell some of the data centers, sell some of the property. So I mean, if you're going for our webinar later, you can ask them that too. The second driver for them, for Singtel, would be if a recovery in their non-telco business, which is like some of their IT service business, which is the NCS. So that is the one that's growing, and the data center business where they are going to start turning on 2 data centers. So all this will help earnings. The third thing is that if mobile competition start to be a bit more stable and then start to recover, that one's unknown. So for us, it's always Australia is always the big drag for them. So these are the three things. The first two pretty confident. That means they might want to sell assets. But mobile competition is always a bit hard to predict because it depends on what the competitors want to do. But they are beginning to see better pricing in, of course, India. Maybe this year not so much, but Indonesia also starting to recover. And another trigger is that they're also selling assets in Thailand. Almost 50 or 2 or 3 billion. So that is also a positive for them. So it's mainly about selling assets for them. But for us, we're neutral now. I mean, just to kind of wrap up the answer. Hi Paul, what's your view on oil price? Is it likely to keep increasing for the next 6 to 12 months? Okay, yeah, I'm obviously like 90% of my prediction is always wrong for oil price, but let me just share with you my view. I think it's going to be a bit flattish. So why? I mean, if you want to know why, supply is increasing from Iran actually. So so if you notice the latest news, there's a bit of toying between there's the relationship between US and Iran. They are releasing some money out of South Korea and giving it back to Iran. And then number two, Iran production is also increasing. Then the second thing is supply can also recover quite fast because as you recall, I think Saudi Arabia also cut some of the production. So there's also a bit of hidden supply that Saudi Arabia could turn back on. So I think supply is then of course demand. Although China has imported more, so I think demand isn't that strong because I think we are a bit as you would note, we are a bit negative on global growth. So we think demand is also not that particularly strong. So that's why we think it's a bit even. There's also this swing factor of the US replenishing their strategic petroleum reserve. This is strategic because they sold a lot last year. I don't think they're going to buy in the election year. I think it's a bit ridiculous to buy and prop up oil price. So that demand will only happen in 2025. So I think 2025 probably the outlook for oil price is better because you're basing on US replenishing the strategic reserve. Obviously, US will not replenish as much as last time because they don't need so much reserve. I mean, US is now in a way it's also an oil exporter, one of the largest. So that's why we think it's even. But our ability to predict oil price is pretty bad. So, but I'll just share with you the factors driving it. I'll hand out over to the rest to have a look to answer.
Maybe I take a question on KIT. The question is, hi Peggy, talking about Keppel Infrastructure Trust here, would the loss of disputable income from KMC be mitigated by the appearance of income from Aramco gas pipelines? Kindly refer to the presentation slide for first half 23. Furthermore, the European onshore wind platform and BKR will further top up the disputable income. DPU will be even more this year in spite of the missing KMC contribution. No. Yes, if you look just based on distribution alone, first half they had contribution from Aramco and the new acquisitions that they made last year, but not forgetting that they had the rights issue this year to which they raised also about 300 million to partly fund these assets. Okay, so shareholders actually you took up from your own pocket to pay for some of these assets. From an analysis point of view, I look at a few things. If you look at the ROIC for the company, it's about 2.3% last year, right? So if interest rates keeps rising, there's not in they will generate negative returns from their assets, right? So that potentially going forward might impair their ability to might impair their cash flows. The way I look at this is that KMC is still in the balance sheet, but KMC no longer contributes to a distributable income. So for a shareholder's point of view, you're holding an asset which is not giving you any returns. So it's just weigh you down. It's just weigh down the balance sheet. So that's why you're paying about a price to book about 2.3 times now. About 2.3 times. So but some of these assets in there are not producing returns for you, right? My third area of concern is that some of these new assets that they acquire, the in terms of distribution is not as stable as KMC. So KMC is like our cogen plant, 1,300 megawatts combined cycle. It's very predictable earnings. Is a take or pay how arrangement. It's a tolling agreement. Well, some of the new assets that they bought, like the Germany, the power purchase, power plant, offshore wind farm, the European onshore assets. These are foreign assets that locally in the country is also subject to sometimes the change in the government policies on setting minimum prices or maximum prices you can charge. When energy price runs too high, all these measures will come in. And some other assets that they already own, like Philippine Coastal Storage, the contribution also fluctuates according to demand. The amount of offtake that they take at all the ports and the silos at the receiving ports. So to sum it up, we have a certainty of earnings distribution from KMC now replaced by new distributable income from new assets which are not as predictable. So the quality of income, I would say, is of a lesser is less than what we could get from KMC. So, but if you're just looking for a distribution point of view, yes, I think the new assets might be able to even exceed KMC's contribution, but they also subject to, they are also not as stable as KMC. Yeah. So in entirety, when you think of being a shareholder of KIT, you also need to think about the value that you're paying for the assets. Whether this deal is sustainable going forward, because the asset value will decline as KMC's contribution get reduced or eliminated, right? That the auditors will come in and give it the lower value for whatever contribution they still can give to the group. So much for this. Yeah, I hope I answered the question. If not, please just follow up with another question. I'll try again. Thank you very much.
Thank you, Peggy. I'll answer the last one. In the light of recent below expectation of China data, what do you say the outlook, their traveling tourism arrival and the effect on CLCT, Lendlease, and Sasser? For Chinese tourism, they are slowly coming back to Singapore, although currently it's only 1/3 of pre-pandemic level. And since China has already restarted the 15 days visa-free traveling for Singaporean, we expect the visa application for Chinese will be less restricted. From my own observation, usually can be done like within 1 week. Also for business travelers, probably can be fully recovered by 2024. And SASA is doing great, as previously mentioned. Their first half 2-3 outlet sales outperform our expectation, and is expected to deliver even stronger second half performance as they have the mega anniversary sales in third quarter. And there's a lot of festivals, such as the National Day, Christmas in fourth quarter. Yeah, so their sales should be good. And for Lilith, the management mentioned they expect the rental reversion of Somerset to be supported by the return of international visitors. And the sales has surpassed it pre-COVID level by 16%. And footfall is already returned back to 100% of pre-pandemic level. And once the tourism return, they expect to increase further. For CLCT, we don't cover the stock, but according to their last result briefing, the retail sales was very much dependent on its location. For the prime location, it's very good, like the Xizhimen in Beijing. Their second quarter 2-3 sales increased by 14% year-on-year. Yeah, and also they guided there'll be stronger retail sales in FY24 and supported by strong rental reversion since the existing list will be end, the one they signed during the COVID period, whereby the rental was very much lower at the time. But office and industrial was muted, followed by increasing supply and intensified competition. Yeah, but generally the retail was okay for CLCT. Yeah, hope it answers your question. That's all for me. Thank you.
Yeah, and just to add on, I think like in our last week's webinar, I think second half is going to see very strong arrivals from China. I think in July you already saw 200,000. A year ago hardly anything, and the prior month was 100,000. So we think second half you're going to see a huge increase in tourist arrivals from China. And the other thing also, do note that although the COVID reopening only happened in April, the impact for tourism won't be immediate because for any large corporate events and so forth, you take at least a year. Nobody was going to plan anything in 2023, even in 2023, because there were so many uncertainties. There'll be shutdowns and so forth. So we think the large events and conferences will still happen, and even more so in 2024. So all this will give quite a good runway for hospitality for the next 12 months. Just to add to what was mentioned earlier. Okay, with that, I'd like to thank everyone for your questions and for your attendance and do feel free to join our community, and then feel free to post any questions if you have. With that, I'd like to conclude and hope to see you also if you do sign up for our Singtel 3 p.m. webinar later. Thank you, everybody, and have a good week ahead. Thanks for your questions and your participation.